first introduction to day trading. So today I'll just go through briefly as to how and what do we do on the day to day. So I'll be covering day trading for small caps in general. As a very start, I think it's very important for everybody to know what is day trading. So day trading is simply just buying and selling any kind of financial instrument within the same trading day. And our goal is to only profit on this short-term price movement, which means we do not care about the long-term move or anything. If we do it on the day-to-day, we are only focusing on the short-term price fluctuations, which means it's mostly technical analysis. So for the pros and cons of day trading, it's actually quite straightforward. So for the pros, is the potential for high returns is definitely there because as day traders, our aim is to capture short-term price movements for profits. And we have very little overnight risk as well because we will never know whether tomorrow we might see like a dump or the stock have some news overnight that we are unable to close our positions as quickly. There's also this flexibility aspect which day traders can adapt quickly to how the market changes. Maybe there might be an offering, maybe there might be some bad news or good news that happens, and we can quickly capitalize on the situation. So one of the big cons out there would be the high risk aspect because day trading can be very volatile, which will result in substantial losses sometimes. And also the fact that you are trading with a larger sum of money, you can be very emotionally stressed, which is very different from investing when you are just putting your money in for a long haul, whereby you're hoping that in the next 10 years time frame you're able to see profit. Day trading is a very skill-based thing, so it requires a lot of deep understanding of the market and also very strict discipline, which also means that you need to have very good emotional control in that sense. Small caps in general, as a guide, is basically 300 million to $2 billion. But most of the time, our stocks that we play actually goes below 300 million as well. Anything below 2 billion or so is mainly considered a small cap. So small cap stocks often exhibit high growth potential and greater price volatility. So when I mention things like higher growth potential, it does not mean that it's a stock worth investing in the long term. It just means that because of how unknown it is, whenever something bullish happens, there's a big upside at that moment. But it does not mean that these stocks will have a continuous high upside because a lot of these companies don't have any actual like money coming in, actual solid financials. So it's something that you have to constantly look out for. So day traders are also drawn to small caps for their potential because of their rapid price movements and profits. So they are not in there. So day traders aren't there for long-term investment. They're just there to play the momentum and the volatility just to make quick profits on that day itself. So the risks associated with trading small caps include limited liquidity, higher volatility, potential for price manipulation, and lack of information. So the risk when it comes to limited liquidity is basically that small caps may have lower trading volumes, which make it harder to enter and exit the position. So over here, you can see one of these charts that I took quite a while back. You can see that after the initial pump, the stock actually dropped. And then at the end here, you can see that there's a lot of like dashes in the chart. So these dashes in the candles actually show that the liquidity has dropped. So let's say you have gotten in earlier in the day during the pump, right? And then maybe you have scaled some out, or maybe you have not. And then you're holding on to it. And when you hit your stop loss, you try to liquidate your position. There is not enough liquidity for you to even exit at the market price. So you may have to result in selling at the bids area where you will have to see the price that you're willing to sell at is way below the current market price. So the limited liquidity in the small cap stocks is one of the bigger risks that we have to watch for. So the higher volatility is also one of the risks involved. I mean, it's both good and bad because initially you can see the big pump happening here where the price just jumped about 11 to 12% just like that within one candle, which is about 1 to 5 minutes. It can jump about 10 plus percent just like this. But at the same time, you also can see the downside where it can just dump 10 plus percent as well due to the higher volatility. So the drop is equally fast and huge, which makes it very, very risky. So you have to be very, very, very careful in that sense. You have to risk manage perfectly. Risk manage in the sense that you might not put in a large size because more position means more gains, but also larger position means more losses as well. So price manipulation is one more thing that is very susceptible to small cap stocks because of the low liquidity. So one of the stocks recently was that it actually had released good news about the company. However, the stock immediately took a 40% dive straight away after the news was released, which didn't make sense because the stock revealed something very, very good. So we expect at least a sort of a bullish momentum upwards. So right after it tanked 40% within the first few minutes, immediately it ran 200 plus percent shortly afterwards. So this was a very clear price manipulation, as you can see here. So lastly, the lack of information in small cap stocks. So there are also very little coverage by analysts and media, which means there's less available information out there. So there's a lot of times that we do not know the full information that the stocks may have. Like the stocks actually secretly already have been like selling off their shares and stuff like that, but these are not reported regularly. So we do not know enough information about this stock to make good judgment based on the fundamental aspect. So on our end as day traders, we only can really focus on the technical aspect and play according to how the volume and the price action is. So one of the very big problems that the new traders always have is setting realistic expectation. Because you always see things on Instagram, YouTube, TikTok, and all these influencers. They always say the insane profits that they have. They always say that, oh, I can grow my account to 300% in a matter of days and stuff like that. And it creates a very shrewd sense of how day trading actually works. It's not that it's impossible, it's just that it's very, very difficult to achieve, which also create a very unrealistic expectation. So it's very important for us at the start to create realistic expectations of our profits. That is just one aspect. The second thing is to understand the risk to reward ratios. So these ratios will help you assess the potential reward against the risk in each trade. If let's say we were to trade purely on one position, right? So at the very start, we need to know with this position, what's the max loss that I can take on. So that's my risk. And then I also need to plan where I intend to take profit. So that will be my reward. So by having this risk to reward in check, I know how much I'm willing to lose and what is the minimum I'm willing to take profit. So this risk to reward allows me to set expectations and properly risk manage myself. So one more thing is that 90% of traders lose 90% of their money in the first 90 days. So although it sounds quite crazy, but this actually happens much, much more common than you think. Because 90% of the traders tend to portion size horribly because they see something move crazy and they think that, oh man, this is gonna move even harder. So they throw in maybe like half their portfolio or even more. So by throwing such large portions of their portfolio, when they eventually hit a dump of like maybe 20-30%, that 20-30% will affect their portfolio even more significantly. So what could have been avoided if they were to put in maybe about 10-20% of their account, when you experience a 50% drop, your account goes only down maybe 10%, which is still very manageable if you consistently grow it back in the next few days. But if let's say you put in like your full account into one play and you experience a 50% down, that means that for you to recover that 50%, you need to hit 100% gain the following day with your entire account for you to make all that money back. So because of this, they snowball into more losses after losses after losses, and within the first 90 days, they will have lost 90% of their portfolio. It's very important for you to understand the risks involved in trading and to manage them constantly. So there's also this continuous learning aspect where day traders need to continually adapt and learn from their previous trades and mistakes. So it's very important for you to track your losses as well. So I personally have an Excel sheet for all the trades that I've taken, and I will track my losses whenever I do have them, so that I can see what's the mistakes that happen. But there are times that losses just happen. That's why it's all part and parcel of trading. So I can't win all the time, but I need to make sure that my losses are something that can be avoided as much as possible. That's the key thing that we need to learn. So there's also this risk management aspect that I've mentioned quite a few times already. So risk management is meant to protect your capital. So risk management can come in the forms of a set of strategies and rules to protect your trading capital. For example, what I mentioned just now, like the risk to reward, setting your portion sizing, and stuff like that. Risk tolerance as well is essential to understand how much risk you can comfortably take on. So this differs from person to person. So for example, each person might be willing to lose maybe $50 to maybe even $5,000 per play. So everybody has different kinds of tolerance to how much they can lose based on their income, based on how much money they've set aside for trading. So if let's say you are very low risk, then your risk tolerance or how much money you're willing to lose per trade should already be set at a certain amount. So if let's say I'm only willing to lose $50 per play, right? If my position hits a negative 50, I have to sell it. Because anything more, it just means that I'm going to incur more losses that I can comfortably take on. So this will help you in the long term. So you should not be thinking that, oh, don't worry, there's a chance for it to come back. Because stuff like this will eventually become more of gambling rather than proper trading. Portion sizing is also very important because you need to know how much you're willing to lose, and then from there you are actually able to determine the size of each trade to limit the potential losses. So stop loss orders also help you to prevent further losses that you already have. So sometimes when a knife comes, it's too fast for you to manual sell. A stop loss sometimes can actually prevent you from losing more than what the dump actually is. But sometimes when the dump is too fast, our stop loss can't trigger in time and we will sell at the bottom of the candle instead. So this is something that is, like I said, part and parcel of trading. So we only can do our best by setting all this risk management aside so that in case when anything goes wrong, all the money that I've lost in that trade is something that I can earn it back in the next few plays or so because I've already planned for it from the very start. So if you don't enter a trade or enter a position with a plan, you will tend to fail in the long term because you're counting a lot more on the luck aspect. So if you manage your risk properly, you can actually survive longer. So that's basically the basics of understanding and trading small cap stocks. These are the first few things that you need to wrap your mind around. Is you need to create a plan. You need to really know yourself, as in how much I'm willing to lose, how much I'm willing to make, how much losses I can take, how much time that I have for this. Because day trading isn't something like a passive income. Day trading is literally a second job. It's something that you need to put time to get better at. You need to put time to execute the trades. You need to put time to learn. So all these little things are stuff that you need to set those time aside for you to really know what is best for you. Because everybody might have different styles, everybody might have different commitments, right? Sometimes some of you might have full-time jobs that require a lot of your time and you can't monitor the market as tightly. So you need to know, because of all these commitments that I have, I need to find a way to fit trading into it. So you don't ruin your routine at work or routine as and when you do other stuff due to your other commitments. You are able to set aside proper timing for you to know what is best for you. I just want to cover one more thing. So just now I mentioned that the portion sizing is a very important aspect, whereby you need to know how much you're willing to put aside for trading, as well as the max risk per play, and maybe the total max loss in a day. So in the Discord, I actually uploaded this Excel sheet for you to play around with it to really understand how much money you can put aside per trade based on your risk tolerance. So for me personally, if let's say I have $10,000 that I'm willing to trade, so I'll put $10,000 here, and let's say I'm willing to lose about $100 per play. And then the total loss in a day, maybe I'll put $300. So with that, I can see that, okay, the percent loss of my account would be about 3%. And then the stop loss in terms of the full size of each trade, which means by portion, would be 5%. And then here, the one highlighted in yellow, is the portion size per trade, which means this is the amount of money that I will put aside to trade every play, which is about 20% of my portfolio. So what this means is, if let's say 20% of my portfolio hit 5% stop loss, it means that I'll be down around 1% of my capital. So being down 1% of my capital, I'll be able to make it back in no time because it's only 1%. But as you go up the scale, right, from 5%, 10%, 15%, you will need to make even more back for you to break even basically. So my take is that you need to really know, okay, if I hit my 5% stop loss, I have to cut here if I'm in full size. But if let's say I'm in half size, I can afford to double my stop loss. Because if I double my stop loss with half size, I will still be losing the same amount of money that I've already planned for. So with that in mind, I can go longer, I can trade with lesser fear because I've already set my mind that if I lose this amount, I'm okay with it. It will not affect my account growth in general. So basically, I'm protecting my capital. So you normally it's also good to have like a target a day, like how many percent of your capital do you intend to hit every single day. So you need something very realistic in a sense. So if let's say your target a day is 2%, you would only need about, let's say, uh, a net winning of two trades, assuming each trade gain is at least 5%. So if let's say you hit about 10% in one play, then basically you already hit 2% of your account growth. Because if you hit 10% of your 20% of your portfolio, you would hit 2% gain of your entire account. And then if let's say you are consistently able to hit 2% every single day for a full year in 2024, you are about able to grow your account by 100 times. Realistically, if you are able to consistently hit 2% account growth every single day, the compounding effect itself is already very, very incredible if you can grow 2% daily. But 2% in the initial start, you won't really feel the growth because initially 2% will only seem like a very small amount. But as you keep growing that 2%, as your account keep compounding, that 2% will become bigger and bigger and bigger and bigger. That's how you're able to grow your account consistently. So 2% every day for 20 trading days is around 48% account growth in a month. So you can imagine if you got 48% for maybe 12 months, you are able to grow at around 170 times around there, if my maths is correct. So it's very important for you to know that compounding is the most important aspect, which is what PPT has mentioned many times before, taking base hits. When the market is bad, taking base hits is how you are able to grow your account consistently, right? So that's the most important thing in terms of trading, is so that you are able to have that longevity in the trading game and not just, quick profits and then you're out forever. It doesn't work that way. Of course, when I mention 100 times or 120 times, there will be an issue of liquidity in the future, which means that let's say my account grows to about 500k, right? And then when my account grows to 500k, I might have issues with filling up 20% of my portfolio properly, right? Because let's say I throw in 20% of 500k, there might not be enough sellers to let me buy up 20% of my shares. So because of that issue, I might not be able to fill the full 20% that I'm looking for, and it ended up maybe only filling up 10. So because of the decrease in portion sizing, my account growth might actually start to slow down after a certain point. But by then, the actual gains from every play would have been very, very big already because of the constant compounding that you've been doing the past few months. So it's very important for you to understand that all this planning ahead will help you to achieve a longevity in the trading game.